FedEx unexpectedly reporting earnings in the last hour. It had been slated to come out after the bell. Let's get to Frank Holland at the NASDAQ with more. Hey, Frank.
Hey there, Mike. As you see right there, shares up after that surprise announcement. I spoke to FedEx. They said this early announcement was a result of a filing error and not intentional in any way. That was really the biggest surprise of this whole thing. The revenue and EPS, basically what they pre-announced last week. The company also laying out the plans for its cost-cutting measures, as much as $2.7 billion. The bulk of that's going to come from its Express division, including reducing flights for its signature air delivery and parking planes, up to $5 million in cuts from its ground service. That's the e-commerce focused division, closing some facilities and even cutting Sunday delivery. By 2025, is looking to cut $4 billion as part of an overall transformation plan. Also, starting next year, FedEx will increase its rates starting in January. A 7% hike for Express and ground, almost 7 to 8% for freight, which is basically trucking. In the release, CEO Raj Subramanian saying FedEx implemented cost action and continue to focus on yield management and revenue quality. Some shades of the better, not bigger from UPS. New CEO Carol Tomé implementing that. When you look at the report, you're going to see a lot of things are going to point a lot of analysts to basically errors in operation by FedEx as opposed to the macro pressure that CEO Raj Subramanian pointed out last week on Mad Money. You're looking at revenues for Express. They were flat year over year, but ground was up 6%, freight up double digit. Revenue per package up 16% for Express, revenue per package up 12% for ground. But as you can see right now, shares actually moving higher after this very surprising pre-announcement of earnings for FedEx. Back over to you.
Yeah, just a little bit of relief on the stock given where it's come from. And Sam, I just would ask you about, the transports in general. They've not been friendly in terms of their message for the overall market. But here you have an example of a stock that's down 40%, has a pretty bad macro outlook. They announced some cost cutting and the market says, OK, maybe it's already taken its punishment. Where does that leave us?
Well, I think that it's possibly the situation because when you look at Q3 earnings estimates, the market was expecting a 10.5% increase for the 500 for Q3 as of June 30th. But now that number is only 3.1%, whereas the industrials have actually held up fairly well. And that's where the transports are found, with the air freight being among the biggest sub-industries in that sector. Also, revenues remain fairly optimistic at about 16.9% growth. We are seeing also positive numbers still for 22 as well as full year 2023.